This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jonathan Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. On set right now is our interview of the day for those of you concerned about the persistency of inflation. Andrew Hollenhorst is Chief US Economist at Citigroup and has been shockingly prescient about elevated inflation, not only in America, but for Citigroup worldwide as well. Andrew, I want to go back to yesterday's free-for-all on 1 year, 6 months, 3 month, 1 month annualized. John's beautiful job there on PPI. Seriously, the granularity of the data. Are we getting way too granular here, Andrew? Are we so desperate that we're just looking at every single tea leaf?
Well, I really think you have to do both here, Tom. And I would say for John, PPI is one of the hardest releases to read. You have a lot of different subcomponents, a lot of different core measures. And we look at all of ththose things. We look at those things in core CPI also, the super core. We're looking at various measures of underlying inflation, 1 month trends, 3 month trends. So you have to look at the details, but then you have to look back, step back, and look at where is the trajectory broadly in the economy. So looking at the details, there's some upside risk we're seeing. If we look at inflation in August, we obviously have gasoline prices that are up. Airfares are down 20% since March. That's certainly not the experience I've had with airfares. So we think we're going to see those coming up in the official data. That's on the kind of details, the short-term movements month to month. But then you step back and you say, where are we going as an economy? It's an economy that's generating 2% plus growth. It's an economy with a very tight labor market. Wage growth running around 5% by various different measures. That's not an economy that's going to bring inflation back down to 2%. So yeah, we're getting a couple months of softer inflation readings here. That's certainly going to look like a soft landing. I don't think that's where we're headed.
We were speaking with Vishy Turbatur of Morgan Stanley earlier, and he said that the bond market action this week was a head scratcher. Since you got softer than expected economic data, you did get confirmation, at least in the data that we're getting right now, of disinflation. Do you agree, or do you think that this makes perfect sense, that the more the Fed gets complacent, the more concerned people are about longer-term inflation?
Yeah, I think there is a way to make sense of the price action this week, Lisa, which is partly that this soft landing idea narrative and the softer inflation data that's come in was really well priced into the market. Speaking to investors ahead of the CPI release yesterday, it was hard to find anyone who really thought that this wasn't going to be a very soft print. So I think that was already in the price. So then what investors are looking at is some of those details, some of those trends in the labor market, the longer term trends in the economy. And exactly like you're saying, Lisa, if the Fed is going to be finishing up rate hikes and pretty much everyone thinks either they're done or maybe they're going to do another 25 basis points in November and be done, then we're looking at where does inflation go from here? And do Fed officials just need to keep policy rates higher for longer? I think that's a discussion that we're going to increasingly be hearing amongst Fed officials. Is increasingly going to play out in the market, this idea that maybe just the neutral policy rate where policymakers need to leave Fed funds in the longer term is going to be higher.
How much do oil prices, do commodity prices feature into this? I was looking at a Mohammed El-Arian column yesterday saying there's an asterisk next to the disinflation that everybody was celebrating yesterday. And it has to do with oil prices heading toward their 7th weekly gain. Looking at food prices, which are starting to inflect higher, how much do these sort of affect the larger input prices, like the factory gauge ones that we just got?
Yeah, so I think the Fed really got helped out with lower inflation, with gasoline prices coming down, energy prices coming down, food prices that stopped rising as quickly. And we were saying at that time, Fed officials should be a little bit careful in terms of take credit for that downshift in inflation, because Fed policy doesn't really control oil prices or food prices. And now they may start experiencing the opposite scenario where you actually get some of these commodity prices moving higher, most notably energy prices. So that is something that Fed officials, economists tend to look through to the core measures. But I mentioned airfares before. We're getting higher jet fuel prices. That's going to boost airfares. And that August inflation reading, we could get a month-on-month increase on the headline, something like 0.4, 0.5, 0.6% month on month. So that could really kind of change the narrative in terms of how the numbers are coming in.
Andrew, just a simple question. Are we beyond the pandemic? Are we back to conventional macroeconomic analysis?
So I think we can still use conventional macroeconomic analysis. And I think that's one way that we've been forecasting inflation and thinking about inflation staying higher for longer. The idea that tight labor markets do drive inflation over the medium term. So I think that framework of analysis has actually been a useful one throughout the pandemic and then this post-pandemic period. But the idea that the economy is going to kind of normalize back to where we were, let's say 2012 or 2013, I just really don't understand that analysis. A lot of people would have thought in 2013, things looked pretty different than where we were in 2005. So I'm not sure why there's this belief that we would go back there.
So this is the heart of the question. I'm going to get a little wonky here, folks. This is wrapped around John Williams' R-Start and all the theory mumbo jumbo that Dr. Hollenhorst is really quite good at. The school of thought out there, Andrew, is that we return to a quiescent R-Start, and then there's debate. I'm going to wrap it around what Olivier Blanchard has done, where there's a new higher R-Start set, or dare I say people debt worried, looking at an even ever higher R-Start. Where are you on this? How do you position R-Start out 3 and 5 years right now?
Yeah, I think we have to think about the possibility, at least, that R-Start is migrating higher. And if you take the famous Laubach-Williams model, which to your point, Tom, is full of complexities, and the idea is you're doing this so-called Bayesian update where you look at the economy and figure out where R-Stars. I mean, you can very simply, you can say essentially what that model is doing is saying, if growth comes in higher than we expect, if inflation comes in higher than we expect, then it must be the case that the neutral real interest rate is higher than we thought it was. Well, where has growth come in? Stronger than we expected. Where has inflation come in? Higher than we expected. So that model over time should start catching up to what we've seen in the data that it looks like R-Star is rising. I think we're going to hear about this at Jackson Hole. I think that really could be the interesting conversation that Powell brings up. Now, to your point, New York Fed President Williams, the father of the Laubach-Williams model, I don't think that he thinks that R-Star has moved up yet. He's made comments to that effect. So Powell, I think, can't kind of completely break away from what Williams is talking about. But let's watch Jackson Hole at the end of this month. I think we're going to hear some discussion about the possibility, at least, that R-Star is higher.
How long can the Fed hold rates around these levels, 5.25% to 5.5%, before it causes recession at a time where perhaps growth is still strong, but it's coming down?
Yeah, I think there are lags of monetary policy that will very slowly but surely slow down the economy. We see that in the senior loan officer opinion survey, where you see banks that are still tightening lending standards. You think about many people right now have a mortgage at 3%, 3.5%. Mortgage rates for a 30-year fixed rate mortgage are 7% now. So over time, people will start slowly but surely resetting into those higher mortgages. But those effects that slow the economy work with a very long lag. Mm-hmm. You're not going to be very incentivized to sell your house now and go pick up a new house at a higher mortgage rate. So that will only happen if you have a life event. You change your job, your family size increases. So that does slow the economy, but it takes a long time. So Lisa, it could be quite a long period of higher for longer.
Andrew Hollenhorst, thank you so much. You'll lighten up the airways. We're getting all sorts of emails here on Andrew Hollenhorst.
Emily Roland joins now, co-chief investment strategist at John Hancock Investment Management. Emily, don't worry, we'll keep them in line. Let's talk about China. Emily, do we want stimulus out of China right now if you have a seat at the Federal Reserve?
Well, I don't know if it's working necessarily. You look at some of this loan growth data this morning, and it's simply not showing up. I think the China stimulus narrative is one that the markets have really loved and embraced, and we're getting a bit of a reality check on that. As it relates to commodity prices, all of this news of stimulus has certainly pushed them up, pushed inflation expectations higher, and that's become a big problem for the Fed here, who certainly has not yet claimed victory on inflation. So we're watching that really closely here, but a lot of mixed messages. And by the way, speaking of mixed messages, I understand trying to get to the weekend here, as you've said all morning long. If you watch the macro and you watch the fundamentals this week, the market action didn't really make a ton of sense. Of course, we had the Treasury auction that you talked about pushing yields higher, but at the same time, the economic data were pretty disappointing. Right. You had softer inflation, you had initial claims picking up, you had dovish comments from the Fed. Meanwhile, the 10-year Treasury yield sort of right where we started, and European equities trading on another planet right now.
And Emily, within your note, you talk about whipsaw, and I think it's perfect. There's one big group whipsaw here over the last number of weeks, whatever anybody's belief. With that said, in the group whipsaw that we're in right now, how do you position out 1 year or 2 year in my depleted 201k?
Yeah, it's tough. So the macro signals right now are like a stoplight. They're going from red to green and back to red. And we look at the macro messages right now as more of a yellow. You want to maybe take your foot off the gas a little bit. You want to look both ways. You want to proceed with caution. So we're starting to see this big shift in sentiment. It's been pulled back a little bit over the last couple of weeks from fear to greed, and you're starting to see more cyclical, higher beta parts of the market outperforming. We would be mindful of taking too much risk in this environment. Again, we still want to be invested. We still like higher quality stocks. We think bonds can do more heavy lifting in a portfolio. But look, the leading economic indicators have been negative for 12 straight months. The yield curve has been inverted for 13 straight months. I mean, it's just become exhausting. But we need to stick to our premise here. We need to stick to our work that tells us that a recession is likely to unfold due to the lagged impact of Fed tightening. But it's becoming difficult to stay patient for sure.
I just want to pick up on what you said about European equities trading on another planet. What do you mean? And just the fact that they haven't sold off more aggressively in the face of China weakness?
Yeah, I think it's notable to look at the strength, particularly versus domestic equities as of late. Europe has certainly been more tied to China stimulus. You've seen that. You've seen a big momentum trade there, I think, as some short covering has resulted in a lot of gains in that market. And you're seeing, some major companies in Europe disappointing on the earnings front, some solvency issues there. Markets really seem to be very much enamored with Europe. They're very much enamored with this China story, and it just doesn't match up with the macroeconomic data. Look at the Citigroup Economic Surprise Index. It's surging in the United States right now, and it's about negative 100 in Europe. And yet those markets are outperforming. To us as macro investors, we want to continue to emphasize domestic equities because of the relative economic strength here.
That said, U.S. tech underperformed this week, I should say, not this year. This year they've outperformed tremendously. But how much is that going to be a real challenge to your thesis if it continues?
Yeah, we've definitely seen a pullback there. And of course, valuations were stretched and we were expecting to potentially see, a bit of a profit taking there. And, I still wonder if tech is the biggest issue that markets should be focused on. It's hard not to like quality in this type of a market. And of course, tech is your poster child there. I think over 3-5 years, we've seen that U.S. technology sector has produced of the best earnings globally. Of course, we want to diversify from some of that. Look at some of the ways the sectors that are starting to perk up a little bit here. Healthcare, one of our favorites. It's trading at a meaningful discount to the S&P 500. It's got the quality metrics that we love, great balance sheets, good return on equity, and it's more defensive. So I do think that the baton can be passed here in the back half of the year into next year to some of these more defensive sectors in order to create that balance away from the tech sector.
Emily, final question. Are you on the strong dollar train as well then?
Yeah, we have been. The way that we look at the dollar is where's the best relative economic growth and which central bankers globally are going to be continuing to tighten the most. And because of the relative strength we talked about here in the U.S., we think that's the U.S. Federal Reserve. We think the U.S. economy is doing the best. We also think if a recession unfolds, which is our base case, there should be a bid for U.S. dollars. I don't know that the dollar goes gangbusters like it did in the first few quarters of 2022, but I would say I would fade any weaker dollar trade here.
European markets on another planet. That's the headline from Emily Roland of Jon Hancock. Whether you intended that to be the headline or not, it will be. Emily, thank you.
To brief you forward into next week, Joseph Feldman joins us, senior research analyst. He's working with Dana Telsey at the Telsey Advisory Group. They've been on fire the last 48 hours. Joe, I want to get to big box, but I really want to frame out the difference here. At Target, I've got a women's boxy zip-up denim jacket, Wild Fable blue denim, for $35. That's what you're looking at. Your colleague in crime, Dana Telsey's, looking at the Medusa 95 Dua Lipa denim jacket over at Versace for $1,350. When all this is done 3 years out, is there going to be anything left in the middle between Coach, Kors, Versace, or LVMH and Target? What's the middle end up doing in the coming years?
Yeah, the middle is kind of squeezed right now, and that's where we're seeing that middle has been trading down. And then the upper end is kind of staying where they are. It's that aspirational customer has traded down a little. The middle has traded down. So I think that still positions Target and Walmart pretty well. Dana, I think, likes the deal with Tapestry and Capri in the sense that you can bring these two companies together. They're a house of brands. And I know they're more of those middle aspirational type brands, but you can operate them more efficiently, and maybe the way you allocate resources to the different brands and do the back end can make it more profitable and make them more of a stronger venture to go forward. So I think that we kind of like that lineup and the strategy there. And, honestly, the Capri side has been kind of languishing for a little bit. And so I think that now if you put it together, you could maybe make a go of it, make it stronger. That all said, the near term, the consumer is still under a lot of pressure. Discretionary sales have been slow, and especially big ticket discretionary sales have been slow. And so that's where we're at heading into this earnings season and why we like Walmart into the earnings season.
Well, Walmart year to date outperforming Target by a massive margin, underperformance from Target, outperformance from Walmart. Joe, there's a word I really don't like around the retail names. It's shrink. Why don't they just call it what it is? Theft. And how much are we going to be talking about that next week?
Yeah, I think we're going to hear a lot about shrink next week. Target has laid it out and told us, they're expecting around 500 million of incremental shrink this year. Walmart's got a big number as well. Now, they haven't quantified it, but it is big. And Home Depot and Lowe's and Best Buy, and you go down the list, and it's been a big problem for everybody. I mean, theft has really kicked in higher. The shrink side, there's always been damages, returns that you can't really sell. Things that maybe walk out the store with an employee every once in a while, things like that. But this organized crime that's happening in retail is really a big problem especially for these big box retailers. Dana actually recently was in Beverly Hills and witnessed it firsthand, one of those grab and goes, somebody just running out of a high-end store and literally right in front of her. And it's frustrating to see, and it's scary for the average consumer to see that happen.
And it's something that we've seen particularly with respect to a lot of drugstores, particularly in city centers. I'm wondering how much this pushes the emphasis then on the online presences of some of these companies. And I think of Walmart in particular, which is actually putting up competition to the likes of Amazon with what they can offer in e-commerce.
Yeah, absolutely. I mean, the e-commerce side of the business at Walmart, at Target, really many of the big boxes have improved significantly. They're very robust. And, we see Walmart as going toe-to-toe with Amazon, especially on the retail side of the business. Clearly, Walmart doesn't have AWS. But on the retail side and the physical presence, to leverage the physical with the digital is a real advantage, especially relative to Amazon at the moment. Now, Amazon wants to get more physical. They're trying to open grocery stores. I think we'll see that accelerate once they've kind of figured out the box that they want. But there's definitely this conflict is going to be around for a while. And you can get great value at both of these retailers. Add in Target, add in Costco, add in all the other big box guys. And you're absolutely right. That is a way around this. We have seen e-commerce sales decelerate a little bit, broadly speaking in retail, as people have returned to the stores a bit more. But that's definitely a strong area of opportunity for the retailers going forward.
Walmart's kind of a confusing read on the U.S. consumer, because on one hand, if it does well, that's a good thing. People are spending money. On the other hand, it's been people who are trading down, who are trying to spend less, who are going from Whole Foods or Whole Paycheck, as Tom likes to call it, to Walmart and looking for a bargain. So is Walmart's gain everybody else's pain? Is it sort of a counter indicator of consumer strength?
Well, that's a great point. That it is an indicator of where the health of the consumer is. Now, the good sign is the consumer is still spending. They are trying to save money. They may be trading down. They may be trading in. But Walmart has done a really good job over the past few years and making that their business model stickier. And so they're retaining a lot of those customers. So they've seen trade down and trade into the business, but they're seeing those people stay. So yes, that's not great for the rest of retail. It just shows that Walmart's gaining market share. But some of their latest formats, like especially the ones over in New Jersey, if you just cross the river, they're really phenomenal stores. And they're very much Target-like, to be quite honest. It has that little slightly more upscale feel, really goes after the core American consumer. And you're absolutely right. We are concerned about how things will shape up, especially for that middle-income consumer for this holiday season.
So, Joe, we talked a little bit about the prospect of trade down to Walmart. We've heard that over the last few quarters from the company itself on the earnings call. Joe, what about holding on to talent? We've seen a bit of softening in the labour market. You're talking about maybe the economy deteriorating. Do they have that issue on the talent side? Do they have a UPS problem? Do they have a problem like GM, Ford?
I don't think so. I think Walmart and Target and all these guys have done a really good job over the past few years of trying to pay their people better, to raise wages, starting wages, I should say, and raise the average wage for everybody. They've added more benefits to their to their employees, and they've done a much better job with that. And we haven't heard as much of the griping that we used to hear a few years ago, especially around Walmart or Target or some of the others that employees felt underpaid.
I ask for obvious reasons, Joe, and I'm jumping in because we've only got about 60 seconds left. I can only imagine how difficult it would be to work at some of those stores in certain locations, at Target, at CVS, when you're seeing people come in, clear off the shelves, and you're told that you can't intervene, you can't do anything, you've just got to step back and watch it. What's happening to those locations? Are they just being shut down?
Unfortunately, some have been. I mean, you saw Walmart shut down a couple of stores in Chicago. Others have shut down stores in San Francisco and other parts of the country. The retailers tell us there's definitely isolated pockets and they're limited to certain stores. It's not everywhere, but it's a concern and it's scary for employees. It's scary for the shopper while you're there. And it's very frustrating too. I mean, we keep hearing stories of employees that occasionally step in and when they're told not to, and yet it's just so frustrating to them that they step in and try to stop it. And some have actually lost their jobs for doing so because, it does put them at risk. It puts the company at risk and puts everybody, the shopper at risk as well. So it's best to let the people go, but very frustrating for sure.
Some shocking images. Joe, thank you, sir. Joe Feldman there of the Telsey Advisory Group going into earnings next week.
About, yes, U.S., China, China, U.S., but also the complexities of other nations as well. We have an expert on this, the banker from Arkansas, the Republican French Hill joins us this morning. French, you in Arkansas live this. You're absolutely front and center on agriculture. I'll use Tyson's as the iconic chicken maker and also pork. And the simplicity that's in the political dialogue versus the complexities of chicken from America to China, chicken from Brazil to China, and the stew of it all, not to use a pun here. What is your best policy with China, given the complex realities of a multinational export-import reality?
Well, Tom, Jonathan, great to be with you. Yeah, this is a super complex issue. We're not confronted with a Cold War situation like we had in the 1950s to the 1990s with the Soviet Union, where we were not an integrated economy there. The case is exactly the opposite with China, for Japan, for South Korea, for Taiwan, for the United States, and for the EU. So first of all, I think your comment has to be thought of in a multilateral way, because all these developed economies have supply chain and market revenue opportunity in China. This de-risking that we're seeing, led by the private sector, I think is one of the most important components of why you see concern in China. And I hope that's the case because, in my view, economic deterrence to Beijing is one of the most important things that we can do on a multilateral basis to keep them from being provocative vis-a-vis Taiwan or the South China Sea. And I think that's a key point.
French, we're thrilled to have you on as you are the only Republican that will not be debating here at the end of the month. It's good to see at least one Republican won't be up on stage. But French, can all of Washington, Democrat and Republican, the bipartisan China view, can we have an adult, multilateral, and complex discussion? Or are we just going to end up with silly simplicities that we hear and listen to now?
Yeah. Such a good point. And that's why I think Mike Gallagher, who chairs the China Select Committee on behalf of Speaker McCarthy, has got a good worldview. He comes from obviously a military background, but he understands these global capital market and trade market complexities that are multilateral and not solely with the United States. And that's why I was glad to see the G7 countries think about a reverse CFIUS type approach at the G7 meeting. This is the essence of where Joe Biden's going with his executive order yesterday. I do agree that I think it's more complicated. I don't think it goes far enough because everything in China is a dual-use technology, and that's how they operate. So it makes very hard for us to monitor and think about how to limit capital flows or technology flows into China.
That's the China story. There's a very big domestic story that was highlighted last week by Fitch that a lot of people are discussing, especially in light of the auctions, which were okay to poor as the week went on. One thing that Michael Zezas of Morgan Stanley said in a recent note was, we're taking seriously the risk of a government shutdown this fall. Do you think that a government shutdown should be on the table in order to reduce the deficit?
Well, Lisa, here's my view. The House is behind the curve here. We need to pass the other 11 appropriations bills that we did not get to in July. We passed one. We need to pass all 12. That gives us the maximum negotiation capability on behalf of the House of Representatives with the Senate and with the Biden administration to get the kind of spending deal that we anticipated from the debt ceiling negotiations. We want to hold the line on that. And the best way we can do it is to get our work done on the appropriations bill in the short time remaining. Those conversations are going on every day. Secondly, look, if we can't get all that done before September 30th, I think a short-term continuing resolution in order to get that work done is important. We don't need to go into a government shutdown when we've done the hard work through the debt ceiling negotiation, and we've done the hard work in our committees, both in the House and Senate, on the appropriations process.
Is there enough unity right now within the Republican Congress members and senators to really get an agreement that everyone can get on board with? Because it was splintered in order to get anything through. Is that one of the big obstacles for you?
Yeah, I think it is, Lisa. I think we are talking with our members every day, as we've done all year, as we've accomplished, I think, a broad set of solid policy accomplishments this year, that some of which have even gone to President Biden's desk. We have to do that on each of these appropriations bills. You've got concern about each one from different members of the Republican conference, and I think that's good. I think it's constructive. We can handle some of that with amendments on the floor, but we do need to get these bills moved forward because, look, that maximizes our negotiating clout, and I would say to my Republican colleagues, if you go to a continuing resolution and don't do your work, what you're doing is essentially institutionalizing Nancy Pelosi and Joe Biden's spending levels of last year and their policy positions, which is not something that House Republicans are in support of.
You know, French, we got to cut to the chase on what matters here. You and I have talked about this before, but if you look at Razorback football, and you look at the schedule of Western Carolina, Kent State, BYU, LSU, finally a real game, LSU and Texas A&M later on. What in God's name is happening to college football, and what are you going to do in Congress to tell these people to get their act together?
Well, let me tell you, Tom, this is all about the money. And those schools love coming to Arkansas. They're going to make a lot of money, and I guess the Razorbacks are going to hopefully have 3 victories in a row. But college sports is now absolutely all about the money. And that's why Jonathan needs to come out here and watch some good SEC football and stop talking about, quote, European football, close quote.
French, I've told you,
frame it.
French, we're going to make it happen. It's a dream of mine. I want to make it happen. I want to go and watch college football in the South. I want to go and watch it.
To have someone like Congressman
Awesome.
Hill tell us it's all about the money. I mean, that's the most shocking thing I've heard this year.
This year, French, is going to happen. Congressman, thank you. Congressman French Hill of Arkansas.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.